On this week's Emily Now episode, we're going to be talking about repayment privileges. We're going to be talking about payout penalties. I'm going to walk you through an example of a client that was not able to refinance their mortgage and spend a little bit of time talking about the announcement last week of the 1.99% mortgage. Stay tuned. My name is Dylan Gallagher, founder of mlenow.ca. I'm a finance guy that's been helping people and businesses find the money they need for about 18 years. Every week we do these Emily Now episodes to help individuals who are considering a mortgage or a loan or financing of some sort, help them to understand some of the things they need to know, give them some real life examples of other people that maybe have been in their position before and what they did. And then we spend a little bit of time talking about the market, and we do all of this because we believe that if you're informed, you can make better decisions about your borrowing needs, and in turn, if you can make good decisions regarding your borrowing needs, then that should give you the ability to save money, maybe invest that money into new things for the future, or maybe give it back to your local community. But at any extent, we want to see you do more, and these Emily Now episodes are an attempt to do that. You can follow us on Twitter at Emily Now Canada. You can check us out on Facebook. You can subscribe to our YouTube channel, and we're also on Google+. And we do all of this as well to support the information that you would find using mlenow.ca for your mortgage or loan. With every episode, we start with a few questions. And the first question that we have today is, what's a payout penalty? This is often not a problem when people first get a loan or a mortgage. This tends to be a problem when they want to go and pay it out. And so a payout penalty is an amount of interest and or a fee that's charged by a bank or lender for a borrower who pays their mortgage or loan out before the term is over. So as an example, you agree to borrow money on a 5-year term. And then in the 4th year, you either sell the property, or if it's a business loan, maybe you come into some money and you want to repay the principal amount. The lender is going to say, no problem, we'll take your money, but we're going to charge you a penalty for doing that. This is because you are repaying the mortgage or the loan before the term is over, and the bank needs to ensure that they've gotten all the money that they can. So there's two basic kinds of payout penalties. There's something called an interest rate differential. You'll often hear the shorthand of IRD, interest rate differential. And then there's a specified amount that they'll charge you, and that could be, say, 3 months interest or $60,000 worth of interest before you can pay it out. The interest rate differential tends to be the one that most people get tripped up on, and the simple example would be, let's say you borrow money at 4%, and then you want to go and repay the bank. You want to give them back their money, but interest rates have dropped from 4% to 3%. So there's a 1% difference there now. The bank basically says, look, if you gave us back our money before the term was over, well, we're not going to earn 4% on it anymore. Now we have to go and give it to somebody else at 3%. So instead of making that our problem, we're going to make that your problem, and we're going to charge you an interest rate differential. So we're basically going to charge you the amount of interest we would have earned on that money had you not repaid us at the full amount. So interest rate differentials tend to only be a problem when interest rates are dropping and people are looking to refinance or pay out their mortgages or loans early. Generally what we see, though, in the last couple of years is something more like just a specified amount. So a bank will say, yep, you can pay us out, but we're going to charge you 3 months interest. Or if it's a commercial mortgage or a business loan, the prepayment, or rather the payout penalty might sound something like, you can pay us out at any time after 90 days, or $60,000 or some interest amount. So as just a quick recap, the way banks make money, you and me put money in the bank, they pay us next to nothing, then they turn around and lend it out to the marketplace. And the difference between what they pay us and what they collect from a borrower is kind of their profit. Now, obviously, it's a little bit more complicated and sophisticated than that, but that's kind of what's happening. So the reason they charge you a payout penalty is because they only make money if the money is out in the hands of borrowers earning interest. And so when you give it back to them, now they've got to find a new place to put that money. And so the penalty is meant to compensate a bank or lender for all of the work that goes into having to kind of redeploy their money again. Banks and lenders need to keep their money working, so payout penalties help banks and lenders make up for lost time. That a payout penalty typically gets charged when someone is repaying a mortgage or loan before the term is over. So make sure that if you are in a situation where you're going to be repaying a mortgage or a loan, that you're very much aware of what the payout penalty is going to be. Our second question today is, what is a repayment privilege? So unlike a payout penalty where the bank is charging you for giving their money back to them before the term is over, on the other side you've got repayment privileges where banks will say, you know what, you can pay down your principal according to a few different ways that we're going to make available to you. So a repayment privilege is an amount of money that the bank will accept and will use to reduce the principal balance of your mortgage or loan without penalty. So for commercial mortgages and business loans, a lot of times banks and lenders will say, as soon as we've earned X amount of dollars, then you can repay us at any time with no penalty. More traditionally though, for residential mortgages, repayment privileges can be a bank will say every year you can pay 20% or 25 or 15% of your balance off without penalty, or you can increase your monthly payment by an amount, and that increased amount can be used to repay the principal balance. So if your payment was $1,200 a year and you want to increase it to $1,500 a year, that the bank would take that extra $300 every month and apply it to your principal balance. So because the bank is allowing you to repay your principal at any time, it's important to know, okay, which times are going to be important to me. Again, most people when they get a mortgage or a loan, they're not necessarily thinking about repayment. They tend to focus more on, can I get approved, can I get the money, am I going to be able to do what I need to do? But after they've gotten the mortgage or the loan and a year or two has gone by and life starts to work itself out, then people start thinking about, okay, well, what can I do here? Can I repay? What are my repayment privileges? And a lot of times banks will compete for business amongst each other by using these repayment privileges as one of the points of negotiation. So, for example, you'll often hear in the marketplace, we have a rate special that we're running. The rate is going to be a no-frills mortgage, and so we're going to give you an interest rate that is below the marketplace, but we're not going to allow you any repayment privileges, because our expectation is, because we're giving you such a great rate, that you're going to keep our money the entire time. Versus other banks that will say, you know what, for a commercial mortgage or a business loan, they might say, look, we really want to compete for this particular business or this particular client because we think they're going to be profitable for the bank. So tell you what, let's offer the borrower any repayment privilege he wants after we've earned a certain amount of money. So if paying off your mortgage or loan is important to you, then you're going to want to do your homework and you're going to want to know what repayment privileges are available to you from the different banks or lenders in the market, because they're not all the same. And it's important to note that not every bank does allow repayment. So repayment privileges, they allow you to give the bank or lender back their money without penalty. Not every lender offers the same privileges, and those repayment privileges tend to be a point of negotiation for getting, a better interest rate or some other terms on your financing. So make sure that you're aware of that. In today's real-life example, I'm going to be talking about a hockey player that is a client of ours. It came through mlenow.ca looking to refinance a property that he owns. And as it turns out, he has a first mortgage on the property and a second mortgage on the property. And the reason that he has a first and a second is because years ago when he bought the property, his credit wasn't excellent. He had some blemishes, if you will, in kind of his financial standing. So the only way he could purchase this property that he wanted to purchase was to do a first mortgage with a trust company and then a second mortgage with a private lender. Well, life's kind of worked out for him. He's made a bunch of money and things are okay. And now what he's looking to do is to see if he can't maybe refinance the property, pay out the first mortgage, pay out the second mortgage, save himself some interest, reduce his monthly payment. And as we started working through the file, we saw that, well, sorry, you're not going to be able to pay out that first mortgage. The particular trust company, it was a broker, a mortgage broker arranged mortgage, and so the trust company that ended up funding this mortgage has a clause in their mortgage agreement that says you cannot repay this mortgage unless you have sold the property. Can't repay this mortgage. You can give us any song and dance you want, you can give us any story you want, and it can be really sad, but it doesn't change anything. We lent you the money, you've got to keep it for the term that you agreed to keep it, and in this case it's a 5-year term. So what does that mean? Well, it means this guy either has to sell the property to somebody else and then maybe purchase it back, or he just simply is going to be stuck with a first mortgage and a second mortgage until such time as the term comes up, and then at that time he can refinance or renew the mortgage, or probably won't want to renew it. He's going to refinance it and kind of pay everything out. Now you'd be surprised to hear that we hear about this all the time. In fact, several times a month we will get phone calls or people will come through mlenow.ca with a request for a mortgage, and the bank would have said to them, look, you can't repay us, so they're going to the market to see if maybe there's some other options, and there really isn't. I mean, it is legal. A bank can force you to keep their money until such time as the term is up or other conditions have been met. So in this particular case, much like the other cases that we see, it's important to know if you're in a position where maybe maybe your credit's not great and you've got to go to a bank or a lender that is going to approve you, make sure that you stop for a minute and say, but am I going to be able to refinance this? Am I going to be able to do something different with this property in the future if my situation changes? We had an example a few months ago of a construction mortgage on a property here in town, and somebody bought a property. They used a different company, a different trust company, to close on it, and their intention was to take down the property and build a new property on it. And so when the time came to put their construction mortgage together, they came through mlenow.ca to see what their options were, and sure enough, they didn't have any. The property was encumbered or had a mortgage on it from a bank that does not allow the mortgage to be repaid unless the property is sold. And so in that particular case, the individual did end up selling the property to a friend of his, who ended up tearing down the house and building up a new one, and so they were able to make it work. But the point was, I think it was about 3 weeks of the borrower going, well, what am I supposed to do now? I mean, I bought this property, I was doing this transaction, the person that was helping me at the time, how come they didn't tell me? And so it caused a lot of angst. But we see it all the time, and so much like this particular hockey player who couldn't pay out his mortgage, his financial situation had gotten much better, but the bank really didn't care. It was written right into their agreement that the mortgage could not be repaid. You too should do your homework and make sure that you're very much aware of what options you have. This particular hockey player, he can't access the equity in his property. So overall what happens is he just ends up seeing his income go out the door to interest. And if he would have had someone helping him at the beginning who knew what they were doing, he probably would have been able to get a more flexible mortgage that would have allowed for a refinance, would have allowed him to repay a second mortgage and a first mortgage with a brand new first mortgage at a lower interest rate. But instead, he's got to just keep paying the bill until the term is up, and that basically is lost money. The interest that he's paying on that is lost money, which is too bad. So don't let that happen to you. If you've been following the news in the past week or so, you would have seen the announcement last week by Investors Group that had said they were offering a 3-year variable rate mortgage with a 1.99% interest rate. And the big brouhaha, of course, was that interest rates haven't really dropped below 2% for a few years. And so this sort of was a signal that, whoa, wait a minute, what's happening in the marketplace if we're seeing mortgages at 1.99%? So I have a couple comments on this, and firstly, I think it's important to note that nothing in life is free. I live my life by this idea that everything is just a chicken trade, and so you have to figure out where the chickens are being traded. And in this case, when you hear that someone has stepped out or a lender has stepped out to offer that kind of an interest rate, you should probably ask yourself, well, is this too good to be true? And sometimes it is, sometimes it isn't. In this particular case, Investors Group, pretty big company, they know what they're doing. It's a great marketing strategy for them because it helps them bring new business in the door. So if there were people that were kind of in the right time and place and needed a new mortgage, 1.99% on a 3-year variable might be a good deal for them. But more importantly, the chicken trade there, of course, would be that Investors Group wasn't born yesterday. They've been around for a very long time. And so if they're offering a mortgage at that kind of pricing when the rest of the market can't do that, then they've got to make it up somewhere. And that somewhere might be in the other products or services that they're hoping they can offer that client that comes to the door for a mortgage. And so if that's you and you're going to be looking at that 1.99% mortgage, make sure that you chat with your Investors Group rep and understand kind of what some of the other terms and conditions would be. So I find it interesting because it continues to be part of what we see happening in the market right now, which is banks just are trading business. There aren't a lot of new customers coming to the marketplace. There's certainly not enough new customers coming to the marketplace that banks can continue to increase their profit and their revenue. So what they're doing is they're trading business. And we've seen with Bank of Montreal that they offer a mortgage special every couple of months that's a little bit lower than the rest of the market to try and grab in some business. We saw a few weeks ago that RBC tried the automobile sales strategy of employee pricing to give their employees some encouragement to bring their non-Royal Bank mortgages over to Royal Bank. And so I think all of it just generally speaks to this desperation that banks and lenders have to try and capture new business and market share. I think Investors Group is interesting because they're not really one of the big banks, and they did it for totally different reasons. They really wanted to, I think, work for Investors Group, but I'm assuming that they're looking to try and drive new business to their door, whereas what the other banks tend to do is they just trade business amongst themselves. And so interesting to see Investors Group offering a product and a special like that, and it'll kind of be interesting to follow it in the news and to see how all of it shakes out. As a reminder, I would encourage anyone who's listening that mortgages they can be a little tricky to understand if you're getting the best rate and the best terms, so make sure that you do your homework. Just because you see a bank offering a certain rate and it seems to be better than the other rates that you're offering, you should just take a moment to figure out where the difference is. And the banks are usually pretty good, or the mortgage broker or the mortgage specialist that you're working with, they should be able to tell you, here's what's different about this particular offer, and that's why it's better priced. And then for you, just make an educated decision on whether that works for you. If you're looking to figure out what you can afford and what options you might have, I would encourage you to visit mlenow.ca. You can put in a mortgage or a loan amount. You can walk through a series of just point-and-click questions that once you answer them, you're going to be given some options. And then if you choose to take the next step, you can register for an account and actually start putting your details together and either send it directly to the bank or ask our team for help. We have live chat on the website. We'd also encourage you to give us a call. There's real people behind that website that are working hard every day to help people get mortgages and loans. And that's it for this week's Emily Now episode. So we look forward to seeing you again soon.